Hey everyone, welcome back to the channel. Today we're going to talk a little bit about Airbnb. Recently IPO'd, and with their crazy valuation, thought, maybe it'd be fun to try to value Airbnb with a traditional DCF and see what we can kind of come up with here. Not entirely sure how this is going to work out, but we'll see what we can get. So the first thing we're going to do, which I already did here actually, is copy over all the information from their S1. I'll show you where I got all this data, if this is something you want to do on your own as well, or for similar companies. So we're going to go ahead and open up a web browser here. Let's head on over to sec.gov. So all public companies in the US have to file different documents with the SEC, reporting different information, any material changes, anything like that, and then financial information on a quarterly basis. So first, real quick, if you didn't catch that, we're going to click in the top right. There's the more search options. And then for the ticker, it's ABNB. We'll go ahead and hit Find Company. And here we go. This will open up. You'll see the prospectus 424B4. This will be their S1. They also have some amended S1s. This may be something similar as well. So the S1 is the document that a company must file when it goes public. It'll have a lot of different information in it. Maybe we'll have another video another day breaking that down, but it'll talk about how many shares of stock to be registered, the offering price, things of that nature. Some interesting stuff in here. It'll say like what banks are leading the underwriting, how much they're being compensated, things like that. But the 424, this should be the fully completed version here. So we'll see offering price 68 a share for $3.5 billion. Underwriting discounts and fees. You'll see the banks got paid $74 million to underwrite this. Pretty interesting stuff. You can actually, and then it'll list the banks. So the lead underwriter, so like lead left, if you ever hear that, that's Morgan Stanley here. It'll be the top one on the left. Then you'll have Goldman, so they're actually probably co-lead since they're bolded. And then a bunch of other banks that help distribute the equity offering as well. But what we'll do here is if we scroll down, definitely read through an S1 sometime. It's pretty interesting. A lot of information about the company, the industry, things of that nature. So definitely recommend it. But table of contents where you'll just scroll down and then there'll be a selected consolidated financial and other data. This will be kind of a high-level financial data. Should have the main three statements. So here you'll see that this is the income statement. We got revenue. Looks like COGS, they're just lumping into total costs and expenditures. From an operation standpoint, operating income, it looks like they've not turned a profit except for in 2018. Then you add in interest income from debt, interest income and then interest expense from debt, and then other income or loss, provision for tax losses, and then you can kind of look at their net loss. They've operated a net loss every year. So, we'll see if they're free cash flow positive. It might be kind of hard to model this out if they're not with a typical DCF. But so what I did here, I just went ahead and did this because it was pretty time intensive. Went ahead and just copied over their financial statements they've reported. So there's the income statement. Then here we have, what is this one? I skipped over that. That's just the net loss per share. Here's kind of more breakdown of stock-based compensation, but then here's a consolidated balance sheet. Not really your typical balance sheet. They don't really break it out. They have total assets. It actually doesn't tie to anything on here. The working capital, based off the footnote, is current assets minus current liabilities. Do we know if that's really working capital, or are they including other items in current assets that maybe we'd want to exclude? Hard to tell. And so copied that over as well. So we have that here on our balance sheet tab. Then they break out key metrics. So nights booked, and the gross booking value. Honestly, this is probably a pretty important metric, but I'm not super familiar with hotels, so I'm kind of skipping over this. You could probably model out something about how their booked nights is going to increase, and then the average booking is going to increase, and scale revenue somehow that way. But I'm going to keep this a little bit higher level. This is just more try to figure out a sanity check on my end. And then they have some non-GAAP measures, so net loss, adjusted EBITDA. Would love to see the walk there. I actually think they do provide that. And then they have net cash provided by operating activities. Once again, would love to see the walk from net loss to this. So kind of that first section on a cash flow statement. I don't know if they actually provide that because they're making quite a few, I guess, non-cash adjustments from a loss of 150 million to a cash flow of 115 million. So we'll be interested to see how they kind of handle that. And then obviously free cash flow that'll be subtracting out most likely PP&E. And then, so I guess, yeah, like I said, here's the adjusted EBITDA walk. So they do walk us from revenue down to adjusted EBITDA, or I guess revenue to net loss, and they have that walk up in the income statement down to adjusted EBITDA. And then we have, here is the, what is this walking us to? This is kind of a walk to free cash flow, I guess. Yeah, this is net cash provided by operating activities, but once again, we don't know how we get there from net loss. And then PP&E to get you your free cash flow as a percent of revenue. And then looks like that is all they provide. So we'll go back over here. I've copied all these tables over, and this is a pretty basic DCF template. It's just kind of a standard, revenue, COGS, gross profit, operating expenses, EBITDA, D&A, EBIT, tax, take out cash taxes, get an adjusted EBIT, and then from there you'd add back D&A, subtract CapEx, and then the change in working capital. Get you your unlevered free cash flow, model that out 5 years, which we can make the assumptions down here, and then working capital as well. And then off to the right, we can add in a perpetuity growth and try to get a value here. So we'll try to link this up. A lot of the stuff's missing, and we may actually have to just kind of force in free cash flow at the bottom here based off what they've provided, because I don't think we're going to be able to walk from EBIT to free cash flow with D&A, CapEx, and working capital. I just don't think that that's going to be possible based off what they've provided, but we'll see what we can do here. So first we'll link up revenues. And actually, I guess before we do this, we actually need to forecast out. So this is, we're gonna have to pro forma 2020. So let me go ahead and do that real quick. And I'm gonna keep this very simple. So first I'm just gonna take, just off to the side here, we'll just call this 2019. And we're just gonna look at 2019 9 months. What's the percentage of that through the full year? And we're actually just we'll just copy that down real quick. And from there, we'll just kind of use these metrics to back into the full year. So if we take that, divide by there, that would be our full year pro forma. Don't get me wrong, this is probably not the best way to do this. This is just quick and easy to get us a full year 2020 number, just for the sake of being able to plug things into our model here. And let's see what's going on here. That doesn't seem right. Some of these numbers are looking a little wonky. I think it's actually just the ones where I had where it should be formulas here. Now we're getting things that make more sense. Okay. So now that we have kind of a pro forma 2020, now we can link everything back up. So we'll link up through 2019, and then we'll go ahead and come back here and we'll link up the 2020 pro forma. Copy those formulas down. This COGS should be the next line item. Just gotta make sure everything's tying out there. Yep, 2389, 3608. Yep, okay. So you can see COVID definitely had a big impact in 2020 based off a pro forma basis, unless if they have just a huge Q4 rally, which is possible with the holidays, but I guess we'll see. Operating expenses, let's link those up. We're just gonna link that to this total. Copy that over for 19, and then for 20, we gotta come back and take our pro forma. So that's gonna be over here. And then EBITDA, so they actually provide us an adjusted EBITDA. So I'm gonna link up to this actually. We're gonna do something very similar real quick for 2019. And we're just gonna do this as the 9 months as a percent of full year. Looks like some of these numbers are actually a little messed up. Come in here and fix that real quick. we go. Just like that. But then we can come in here and do a 2020 pro forma now. Let me just add a row here, just kind of keep it a little bit cleaner. I mean, I guess really we just want the, but that actually, you know, 9 months in they had positive, and then in Q4 they got crushed. So maybe what we'll do is let's actually just, that method might actually not work here for proforming 2020. What we'll do is we'll actually, let's just take the historical average on percent revenue, and we'll use that. So we'll look at the last 5 years. Average is -2%. You know, I'm not going to give them credit for 2015. Ideally, we need this to be a positive number if we want any sense of. So I guess we'll have adjusted EBITDA be -0.36. That's fine. I can already tell that this is going to be a bit of a wonky DCF. That's probably going to get us some weird values, but we'll see what happens. And then for this, we'll do the revenue times the percentage we just calculated there. So about break even for them is what we'll go with. DNA, they provide this on the, which tab was it? Adjusted EBITDA tab, they do provide this. Copy that across 2020. We're gonna need to figure out a way to pro forma this as well. Let's see, do they give us PP&E on here? No. But we can just do we'll just do a basic, we'll divide this by the total, and then we'll go back so we get the 139, and we'll link that up. So there we go. They'll give us EBIT. Tax impact, based off this, they'd be saving a ton of money to get an adjusted EBIT. But here's where things are going to get a little funky. So CapEx, they do provide CapEx for us. That is going to be, is it here? Yep, purchase PP&E. Link that up there. And actually for 2020, we may need to pro forma that again. So let's come back here and see purchase of PP&E. We'll just do similar, we'll do percent. See what that gets us, okay. So yeah, you can see they cut their PP&E drastically this year, but we'll link that up on the DCF. Oops. There we go. So now we have that. You can see CapEx as a percent of revenue. So we're gonna, let's see here. So yeah, you can see that this EBITDA is nowhere close. They do give us net working capital. So let's plug that in down here. I believe they have that on the balance sheet. They just give us working capital. So we'll plug that in for every year. Should flow through. And I think, yeah, this is 9 months ended. They don't give us the 9 months ended for 2020 or for 2019, since it's like a snapshot in time. Things are always changing, but that does seem really high. It's the highest net working capital, but we'll leave it for now. And we'll just see real quick. Yeah, you'll see this does not give us any sensible free cash flow that's probably even remotely close. Let's look at what they're providing us. They're telling us free cash flow is -123 million. Okay, that's in the ballpark. -730. They're telling us it's positive. So yeah, so from here it's positive every year. About $1 billion over those 4 years, and we have it positive 85. So there's definitely a lot of adjustments going on if we were to take their net income and walk it back, right? So if we took their net income and walk back to this net cash provided by operating activities, that they have a lot of non-cash items in here that you might be able to dig around in the S1 and actually get to the bottom of that. I'm not going to spend the time today doing that. We're just going to actually override our free cash flow with theirs and see kind of some assumptions we can make going forward. So let's go ahead and link this up down here. And so we're taking in good faith effort that the adjustments that they've made are reasonable and something that an investor would take in similar vein. Um, Now, if that's fair or not, I don't know, um, but we'll see. And then we can see here, they've just been pummeled in 2020. So we're going to link this. I'm going to guess it's going to be a little bit higher for the full year, if I had to take a wild guess. But we'll link that up for now. What we're going to do is we're now going to go ahead and we're not going to use these. I mean, really, we don't really care about any of this. We're gonna calculate our unlevered free cash flow on a percent of revenue, similar to what they've reported out, I think, on one of these tabs somewhere. They give us like EBITDA as a percent of revenue. So we'll do free cash flow um, as a percent of revenue. I guess maybe we could do it on a percent of EBITDA. So we'll forecast out EBITDA, and then we'll do free cash flow as a percent of that. So we can look at the historical growth rates here. These formulas are set up. Let me copy these over. 2015 will give us an error. So we can see 80, 55, 30, and then a massive decline here. So honestly, my thought is 2020 is going to be a one-off due to COVID. So I would say let's baseline them back at 2019 at 30% growth. I don't know how long they'll be able to maintain that growth. But let's assume for our first case here that they're going to be able to maintain this for the first 5 years, pre-COVID level growth levels, because we've seen them coming down, right? 80, 50, 40, 30, negative 30 here. So 2021 will really be a good indicator. If they finish the year at 20%, is that going to be kind of normalized growth for a few years, or is it going to continue to decline back closer to a low single digit number, or a high single digit? So let's go ahead and link this up real quick, and we'll just forecast out the revenue real quick here. So yeah, I mean, like, right, there's no way they're going to go from 3 billion to 4 billion to 5.5 to 7.5 to 9 to 13. That's pretty aggressive growth. But for just the first pass of this, we'll leave it at that. Um, you know, EBITDA, they're reporting it here as a percent. I mean, it's negative, so we're just gonna, for the sake of this, we're gonna skip over that actually for now, and we're just gonna actually add in a row here, and we're just gonna call this free cash flow as a percent of revenue. And we're gonna look at how it's trended historically and see, have they been improving or not? Make that a percentage. Let's add, let me actually just take these percentages. They'll look nicer. There we go. Copy that formula over. So it's growing steadily. 2019 decreased. 2020 obviously been impacted pretty bad. So I'm gonna, let's see. If we exclude 2020, their average is 2%. If we exclude 15, right, their average is 5.5. So I'm gonna go somewhere between, or I guess 5.8, between that 5.8 and 2. So I'm gonna give them 4%. That might be aggressive, I don't know. But let me go ahead and do that. It screwed up our formatting, so just re-add these real quick. So let's make that a 4%, and we're just going to hold that constant for now. And we'll come back and we'll tweak these once we see how close or far off we are from a valuation. So we'll go ahead and actually forecast this out now and see what this free cash flow is starting to look like. And see if it's anything remotely realistic. Yeah, no, I mean, that seems like, that's fair. It's growing a little bit every year as revenue grows. Hopefully, things get more efficient, stock compensation, whatever goes down. I guess that's non-cash, so that wouldn't be showing up in free cash flow, but maybe PP&E slows down, less R&D, something to increase your net income before you adjust all the stuff for your EBIT. So we'll go ahead and leave that, and we'll see here real quick. So WACC, we'll just start with 10%, right? And the formatting in these looks off because we gotta just change there we go. So it's in the same, that was in millions and we want it in thousands. So one second, let me just kind of, you can see this is not looking good, right? We're saying, not even including net debt. I don't even know if they give us the information to calculate a net debt. They don't. Maybe they don't have much debt. They just IPO'd. They had a lot of VC funding. So maybe they don't have any debt. Maybe it would just be cash that we would need to add back. And let's see, let's look at their balance sheet. Do they have any cash even? Yeah, they got a fair amount of cash. We'll add that back in the restricted cash. Why not? We'll give them credit for it. But I mean, we look at this, the NPV of their free cash flows. Um, that's $1.1 billion. Okay, not bad. Terminal value, we've seen a 3% exit um, off of that, so 3% perpetuity growth. It's worth 7.5 billion present value of that. So yeah, I mean things are right. This is saying equity value is 10 billion. Let's check real quick. Airbnb, what's their? Let's just go look to humor ourselves. Their market cap is 87.5 billion right now. Okay, so we're almost there. Not quite. Um, I mean, realistically, like, what could we do to make this better? Obviously, we could increase these margins. We'd say you're going to get back to closer to 2017 and 2018. Let's give them 10%, right? If we give them 10%, well, what happens? Well, that's not bad, right? Okay, now they're a $20 billion company. And I think the original IPO range was somewhere between 30 and 50 billion. So, maybe you're saying, oh, no, you're gonna be able to get back to that 14%. You're gonna be closer there. Um, okay, now you're at 25 billion. Um, maybe you can actually get this up to 20%. Cut a lot of expenses, that's a pretty aggressive assumption. Um, Weighted average cost of capital, maybe you're like, yeah, I don't actually need a 10% return. I only need a 7% return. Okay, well, if you'd accept a 7% return, yeah, you could actually probably drop this back down to 7%. Let's see what happens. Yeah, you're still below the original range, so I mean, maybe closer to the 13%. But at 80 billion, I mean, you're going to be stretching pretty far here. So let's say give yourself 3%. You just want, that doesn't even work because it's the same as the terminal growth. Okay, so if you only require a 4% return, they're undervalued, 5%, fairly valued. And this is assuming 3% terminal growth indefinitely. You might say, well, maybe we need to project out 10 years and then do terminal, and the present value of those cash flows will be higher, which is fair. You can make that argument. Um, and I mean, here's a little sensitivity table, right? You can see based off the WACC or the perpetuity growth, what the different values you get here, ranging from 19 to 40 billion, depending on what WACC you use. 8% WACC with 4% perpetuity growth, okay, 40 billion, that's in line with their original IPO, original estimates, but at the 80 billion valuation, it appears to be richly priced. With that being said, you could probably value this some other way. You could try to spin this as Airbnb as a tech company, asset light, unlike hotels. So, you know, there's probably a lot of ways you could spin the valuation here, but based off just a traditional DCF and being blind at the free cash flow and not knowing where these numbers are coming from based off their financials, you have to make some pretty healthy assumptions to get to that current valuation today of 80 billion plus. But yeah, I mean, this was just something I had been wanting to do to kind of look at and see, does this valuation even remotely make sense? How are we getting there? But clearly, I don't think this makes too much sense personally, but um, speculation, you never know. It could, maybe you could argue they're gonna grow 50%, right? So if we say they're growing 50%, you could move this back up to 8, all of a sudden But are they really going to go from 3 billion in sales or 5 billion in sales to 25 billion in sales in 5 years? I don't know. That's aggressive. But they did go from 1 billion to 5 billion in 5 years. So, they were growing at 100% CAGR there. Or I guess not 100% CAGR, but, doubling every year from based off 2019. So, um, could happen. Might be a bit aggressive, and there's a lot of assumptions in that free cash flow as a percent of revenue number there, um, based off how they've historically trended. But if 2018 were to be the picture year, right, sales growth 43%, free cash flow at 14%, um, you could try to base something off that, and you probably get a pretty decent valuation actually, close to the original offering, which is probably how the banks were looking at it, is trying to take 2018, say 2019 was impacted by early onset COVID, something like that. As a bank, you'd spin it that way, and 2020 was hammered, so you would expect 2018 to be more in line with how things are going to go, and growth is going to be supercharged. That might be the way to explain this away, but um, then you get a kind of 30 to 60 billion, which I think is more in the original range. So yeah, this was a fun little exercise. By no means is this any form of investing advice for anyone. This was just a fun kind of thought experiment. But yeah, happy to answer if anyone has any questions or comments about why I did things the way I did. Happy to answer them. Happy to share the template that I use as well if anyone's interested in that. Thanks so much.